Good morning from my lecturer, Tuan Nurul Huda. My name is Kozia. Number is 03D8022F1040. My presentation topic is historical costs. So now I will start my presentation. The definition historical cost is a measure of value used in accounting in which the value of an asset on the balance sheet is recorded at its original cost when acquired by the company. The historical cost method is used for fixed assets in the United States under generally accepted accounting principle. Historical cost is the cost of an asset at the time of purchase. Historical cost is used in accounting to record an asset's original cost and allow for adjustment based on a change in value over time. This idea is also called the cost principle, and it is widely recognized in accounting. It states that all assets, liabilities, and expenses should be recorded at their acquired cost. Historical costing applies to both fixed assets and liabilities on a balance sheet. Since fixed assets are purchased that exist for an extended period of time, they often depreciate or increase in value, so it is important to record the original cost of each asset in order to make adjustments later on. Liability may also change in value, so it is important to know their original price as well. How do I calculate historical cost? Historical cost is often calculated as the cash or cash equivalent cost at the time of purchase. This includes the purchase price and any additional expenses incurred to get the asset in place and prepared for use. For example of historical costing, for instance, consider that your company has purchased a vehicle for company use. If they buy this car brand new for 20,000, that number is its historical cost. That is the amount that they pay for it, and that is how much it was originally worth and how much you would put on the balance sheet. When recording the purchase, however, over time, the car's value will depreciate due to age, mileage, and wear and tear. 2 years after purchasing the car, it may only be worth 10,000 in resale value. This is now the current cost of the car. Now, let's say the car has broken down and the company wants to buy another car. You will need to determine the replacement cost. The replacement cost is how much it will cost to buy the same car. Previously, the car cost 20,000, but 2 years later, that price may have changed. Also, take note that the replacement cost is not the same as the current cost because the car has depreciated in value. You also need to account for inflation when determining costs. If your company previously purchased a car in 1918, you might adjust the price for inflation. If the car costs 5,000 at that time, then the inflation-adjusted cost might be 16,000 in 2021. This is useful way to understand a company's financial history in terms of current buying power and monetary worth. It's important to note that historical cost is not necessarily higher than current cost in all situations. Consider the real estate industry. For example, people typically consider real estate a long-term investment because unlike vehicle, a house value does not always depreciate. It, it, it fluctuates up and down depending on the housing market, and it can become more valuable with renovation. For example, if you buy a house for 100,000, that is the house historical cost. Then 10 years later, you might appraise cost the house and find that its value at 200,000. This is now the current cost. Key takeaway for historical cost is most long-term assets are recorded at their historical cost on a company balance sheet. Historical cost is one of the basic accounting principles laid out under generally accepted accounting principles. Historical cost is in line with conservative accounting as it prevents overstating the value of an asset. Highly liquid assets may be recorded at fair market value, and impaired assets may be written down to fair market value. Other type of cost for one current cost is the cost of the item or purchase in the present. This can be more or less than the historical cost, depending on appreciation or depreciation. The current cost can also be the same as the historical cost if the item's value has not changed. Current cost is also called fair market value because it is based on how much someone would pay for the item in the current market. Knowing the historical cost and current cost of an item allows you to calculate how much you were lost or gained from selling it. The replacement cost is the cost to replace the item today. This accounts for the current availability of the item and for how the item may have changed in price since your original purchase. Replacement cost may be the same as the historical cost if the item has not depreciated. It may also be less than the historical cost if the demand for the item has decreased or more if it has increased. Inflation-adjusted costs determine what the price of the item would be if you had purchased it today. This cost adjusts the historical cost relative to change in inflation, which make the item more expensive today. Inflation-adjusted cost is different from the other types of cost because it simply translates the historical cost to account for inflation. It does not account for the item's depreciation and or expression. Understanding historical cost. The historical cost principle is a basic accounting principle under US GAAP. Under the historical cost principle, most assets are to be recorded on the balance sheet at their historical cost even if they have significantly increased in value over time. Not all assets are held at historical cost. For example, market paper securities are recorded at their fair market value on the balance sheet, and impaired intangible assets are written down from historical cost to their fair market value. Asset impairment versus historical cost. Independent of asset depreciation from physical wear and tear over a long period of use, an impairment may occur to certain assets, including intangibles such as goodwill, with asset impairment. An asset's fair market value has dropped below what is originally listed on the balance sheet. An asset impairment charge is a typical restructuring cost as company revalue the value of certain assets and make business changes. For example, goodwill must be tested and reviewed at least annually for any impairment. If it is worth less than carrying value on the books, the asset is considered impaired. If it has risen in value, no change is made to historical cost. In the case of impairment, the devaluation of an asset based on present market conditions would be more conservative accounting practice than keeping the historical cost intact. When an asset is written off due to asset impairment, the loss directly reduces a company's profit.